The Rise and Fall of WeWork, Adam Neumann's $47 billion fraud. In 2019, a company that rented desks tried to go public at a $47 billion valuation. Within 6 weeks, that number collapsed to $10 billion, then $7 billion. Then the IPO was pulled entirely. The CEO was forced out with a $1.7 billion golden parachute, and the company spent the next 3 years limping toward bankruptcy. In 2023, WeWork filed for Chapter 11. This is the story of WeWork, how a real estate company convinced the world it was a tech startup, how one man's unchecked ego burned through $11 billion in investor money, and what the whole disaster tells us about the era of cheap money that made it possible. If this story sounds familiar, that's because it should. The WeWork collapse is the most instructive business failure of the last decade. Stay with me. Section 1. The idea that wasn't new. Adam Neumann did not invent co-working. That's the first thing to understand. Shared office spaces had existed for decades. Companies like Regus had been doing it since 1989. What Neumann invented was the story around co-working. The pitch was this: WeWork wasn't a real estate company. It was a community. It was a consciousness. It was, in Neumann's own words, the physical social network. Neumann was born in Israel, grew up partly on a kibbutz, served in the Israeli Navy, and came to New York City in his mid-20s with almost nothing. He tried several business ideas that didn't work. Then in 2010, with co-founder Miguel McKelvey, he launched WeWork in Lower Manhattan. The concept was simple: lease large office buildings on long-term contracts, subdivide them into smaller spaces, sublease those spaces to freelancers and startups on flexible short-term memberships, and pocket the difference. That's it. That is the entire business model. Lease long, rent short, markup in the middle. Every commercial real estate company in the world does a version of this. What WeWork added was exposed brick, craft beer on tap, standing desks, and a relentless brand narrative about community and collaboration. They called their members a community, not tenants. They called their spaces locations, not offices. They called their employees WeWork's energy. Investors, for reasons that will become clear, loved it. Section 2. The SoftBank Money Machine. WeWork's growth was not organic. It was purchased. And the man who wrote the checks was Masayoshi Son, the founder of SoftBank and the operator of the $100 billion Vision Fund, the largest private technology investment vehicle in history. Son met Neumann in 2017 for a 12-minute tour of a WeWork location. By the end of that tour, Son had committed $4.4 billion. He later increased SoftBank's total investment to over $10 billion. In a now legendary exchange, Son reportedly told Neumann that, in a fight between the smart and the crazy, he always bet on the crazy. Neumann was thrilled. This is where the story starts to break down into something that's less a business story and more a warning about what happens when unlimited capital meets unlimited ego. With SoftBank's money, WeWork expanded at a pace that was financially indefensible. Between 2016 and 2019, the company's revenue grew from $436 million to $1.8 billion. Impressive on the surface, but its losses grew even faster. In 2018, WeWork lost $1.9 billion. In the first half of 2019 alone, it lost another $900 million. For every dollar of revenue it collected, it was spending roughly $2. This is not a growth stage startup quirk. This is a structurally broken business model being masked by an ocean of venture capital.
The reason WeWork could keep raising money despite these losses was Neumann's ability to frame the losses as investment in future dominance. He talked about conquering cities, about elevating the world's consciousness, about WeWork becoming the largest company in the world. And for a while, in the era of zero interest rates and abundant venture capital, investors bought it. Section 3. The IPO That Blew Up. In August 2019, WeWork filed its S-1, the registration document required before a public stock offering. IPO filings are meant to be dry, disclosure-heavy documents. WeWork's was a spectacle. The filing used the word community 150 times. It contained phrases like, "We dedicate this to the energy of we, greater than any one of us, but inside each of us." It described Neumann's vision of WeWork schools, WeWork apartments, WeWork gyms, and eventually WeWork cities. The document also revealed, for the first time to the public, the full extent of WeWork's financial situation. $47 billion valuation, $1.9 billion in annual losses, and a business model where costs scaled with revenue rather than running ahead of it, meaning profitability was not visible anywhere on the horizon. Wall Street read the S1 and reacted with something between confusion and alarm. Analysts noted that WeWork's valuation, which Neumann had been marketing at $47 billion, implied a price-to-revenue multiple of roughly 26x. Comparable real estate companies traded at 1 to 3x revenue. Even aggressive SaaS companies rarely justified more than 15x. The gap between WeWork's valuation and any defensible fundamental analysis was not a rounding error, it was a chasm. Within weeks of the S1 filing, the company's internal valuation estimates for the IPO dropped from $47 billion to $20 billion, then to $15 billion, then to $10 billion. Investment banks began withdrawing. Institutional investors who had been lined up to buy shares stopped returning calls. Then the personal disclosures in the S1 started to land. Section 4. The Neumann Problem. Adam Neumann had structured WeWork in a way that gave him near total control and near total financial benefit regardless of what happened to other shareholders. He held supervoting shares, 10 votes per share compared to 1 vote for ordinary share, meaning he could not be removed by investors without his own consent. He had personally trademarked the word "we" and then sold that trademark back to WeWork for $5.9 million, a transaction the board eventually forced him to return. He had used WeWork funds to partially finance his personal real estate purchases, including a $21 million mansion in Connecticut with a private music studio. He had flown on the company's private jet to locations that coincidentally happened to be near his own investment properties. He had hired family members. He had smoked marijuana on the company plane. When journalists and analysts began publishing these details, sourced from the S1 and from reporting by the Wall Street Journal, the response from WeWork's board was slow and the response from SoftBank was panic. The Vision Fund's valuation of its WeWork stake, which had been marked at $4 billion on its books, was suddenly looking catastrophically wrong. In September 2019, 6 weeks after the S1 was filed, WeWork withdrew its IPO. The week after, Neumann was removed as CEO. His exit package? $1.7 billion in stock buybacks, loan forgiveness, and a consulting contract. The company he had run into the ground paid him nearly $2 billion to leave. Section 5. The Collapse and the Lessons.
WeWork spent the next 4 years trying to survive. SoftBank, having already sunk $10 billion into the company, had no choice but to inject more money to avoid writing off its entire position. A pandemic made co-working acutely unattractive. A new CEO restructured aggressively, closed hundreds of locations, laid off thousands of employees. In October 2023, WeWork filed for Chapter 11 bankruptcy protection. By that point, its stock, which had briefly traded on public markets after a SPAC merger in 2021, was worth fractions of a cent. The total capital destroyed in the WeWork story? Somewhere between $11 billion and $47 billion, depending on how you count. The human cost? Thousands of employees who lost jobs, hundreds of thousands of tenants whose spaces were abruptly closed, and a generation of startup employees who held equity that became worthless. What does this teach us? Lesson 1. Revenue is not the business. WeWork had $1.8 billion in revenue and was losing money on every dollar of it. Revenue growth that outpaces margin improvement is not a business, it's a bonfire. Lesson 2. The valuation is a story, not a fact. At $47 billion, WeWork was valued the same as Marriott International, a company with hundreds of thousands of rooms, decades of profitability, and real assets. The number was a narrative construct, not an analysis. When you invest in anything, stocks, private companies, real estate, the story the promoter tells you is not the price. The fundamentals are. Lesson 3. Governance matters. Supervoting shares, undisclosed related party transactions, and a board that deferred to a charismatic founder rather than asking hard questions. These are not cosmetic issues. They are structural vulnerabilities that allowed a catastrophic situation to go unchecked for years. Lesson 4. Cheap money distorts everything. WeWork grew the way it did specifically because interest rates were near zero and institutional capital was chasing yield. The Vision Fund existed because sovereign wealth funds needed somewhere to put money that was earning nothing in bonds. When money is cheap, bad ideas get funded. When money gets expensive, those ideas get exposed. WeWork's bankruptcy came 3 years after the Federal Reserve began raising rates. That timing is not a coincidence. Lesson 5. The craziest pitch in the room is not always the best bet. Masayoshi Son's theory, bet on crazy over smart, worked spectacularly in some cases, including his early investment in Alibaba. It failed catastrophically in WeWork. Conviction is not a business model. Numbers are. Closing. The WeWork story ended in bankruptcy. But Adam Neumann has already moved on. He's now raising money for a new company called Flow, a residential real estate startup. And in 2022, Andreessen Horowitz led a $350 million round valuing it at over $1 billion, before it had opened a single building. The American investor class apparently has not finished learning this lesson. If this story made you angry or amazed or both, that's the right reaction. Hit the like button. Drop a comment with one word. Was WeWork a fraud, a failure, or just a really expensive mistake? I read every comment. Subscribe if you want more stories like this every week. We're just getting started.